stream and we'll have an hour together. And the purpose, of course, is for you to ask questions, any questions you like to do with investing, and I'll do my best to answer them if I can. So maybe just a good place to start is to summarise what's going on in markets while you get your thoughts together. I think it's fair to say that we've seen a swoon in risky assets since pretty much Christmas Day. December the 25th looks like it was the peak of the market, maybe the 24th, so Christmas Eve. So far from a Santa rally, it's a bit of a Santa swoon after Santa delivered. So not great for risky assets. We lost about a month's returns, a little bit more already. So not great, not a great start to 2025 rather, get it right. I always spend the first 3 months trying to remember what year we're in. So yeah, kind of risky assets didn't do well, and yields are generally moving up at the long end of the curve. But of course, we'd expect that as the yield curve normalizes. And expectations, I guess, are that we're going to see further cuts at the short end. So steepening of curves is pretty much on the menu for this year. And for risky assets, I think the difficulty is that we've just had 2 blowout years for the S&P 500. So it's going to be very difficult, I think, for markets to generate another 20% plus return for the 3rd year running. Not impossible, but it's always difficult to justify fundamentally. So there's going to have to be some catalyst. Trump and his administration presumably will be doing their best to chivvy stocks along, also to stimulate the US economy. But the real big questions are about inflation and how his policy is going to affect inflation, and then consequently how the Fed is going to deal with that, because it's going to be difficult if it is inflationary, whether they look through the data or whether they respond to it if it is inflationary, his policies. I'd say that kind of is the biggest risk, I think, in terms of macroeconomics in 2025. Anyway, I'm doing a whole video about that, and I'll talk about the economic outlook for 2025, and I think that is one of the biggest risks. Anyway, that video's I just shot it, and hopefully you'll enjoy that. So let me just say also, we haven't done the podcast for, I think it's 2 weeks now. We will be doing another one. We'll be recording it next week. But we've been busy creating videos, certainly. So those will be kind of trundling through. Do please consider our website membership. So just go to PensionCraft.com/membership to learn more about that. And we've had an incredible month actually of new members. So we've got well over 1,000 now. And I think the reason why people stick with us is we don't try and sell stuff. So here is me selling the membership. But generally, we don't sell things other than the membership to people. We don't sell products. We don't try and push you into certain things. Really, it is an opportunity to learn things. And I think that's our approach, which is educate, don't tell people what to do. So we've got a fairly broad church, very wide range of views. And we have a chat application so that people can chat to one another and share information. We're about to announce our free lifetime membership for one of our members who's most helpful. People have voted on it, and so we'll be announcing that soon. And we try and encourage that to help one another, because that's the kind of community we'd like to create. So yeah, do ask your questions, and if you are one of our supporters on YouTube, that will push you to the front of the queue. If you do a super chat also, will push you to the front of the queue. And I should have said Happy New Year. Why didn't I say that? I should have said that at the beginning. There is a very forlorn picture of Teddy, because on New Year's Day we went out for a walk, and Teddy got somewhat soggy. So I'll see if I can find the picture. But he looked very, very unhappy, I have to say. Let me just share that picture with you of forlorn Teddy. Yeah, he wasn't happy at all. Let me just maximize that. Okay, so here is Teddy looking very forlorn on New Year's Day. Very accusing look, I think. My very soggy shoes. We got completely drenched. It was dreadful. Anyway, back to finance. Poor Ted. He'll be making an appearance later, looking somewhat happier because he'll be getting treats upstairs and downstairs. Okay. Let's have a look at Laura's document and just see if there are any super chats yet. No. And Happy New Year, everyone. So let's have a look at your questions. Oh, that's interesting. Okay, so question from Fester Al, who says, given the budget and likely infrastructure spending in both the US and the UK, would a tracker of infrastructure be preferable than a specific fund? I think the problem there is finding infrastructure which is going to benefit from the spending of the government on infrastructure. Another way to play this, you see, my point is that if for example, the if the government is buying a certain project, it may not be part of that fund's assets in which it's invested. The government may wholly own that part of infrastructure. So let's say it's a rail line. If the government's investing in it, you might not own it. So that's the problem. So you've got to find some kind of overlap, or you could go for companies which will indirectly benefit from the infrastructure spending. So, for example, house builders would benefit from the plan, which is pretty much doomed to failure, to build 1 million new houses over the course of this Parliament. So I think a lot of these you can get indirect exposure by looking at the companies which should benefit from government spending and then go for those. House builders would be the obvious one. If the government's going to spend on more building, also, the companies which produce building materials, that's another obvious one. And so that would be another way to play it. But I think infrastructure is always tricky because it's finding the projects which will benefit from government spending. Getting exposure to those projects is not easy. So I think that's more difficult than you might expect. So the indirect route is probably better. Next question is from Gringador, who says, if you buy a single gilt, what happens when it matures? Does it just disappear in your trading account and you are returned cash? Yes, that's exactly what happens. So let's say you buy a 1-year gilt, it trades at £95 today. Well, a maturity will be worth 100. Any coupons will be paid every 6 months. So you'll get one coupon paid after 6 months, another coupon paid on the maturity date. And then on the maturity date, you get that semi-annual coupon and the principal back. So you get 100 back in your account. If it's a 1% coupon, you get half of that 1%, so 50 pence on top of the 100 at the maturity date in a year's time. And it just appears in your brokerage account, so no magic involved. If it is a weekend, we often have this question on Mattermost, which is our chat forum. People often say, what happens at maturity? Because it is kind of scary. You buy the gilt, you don't know when it's going to appear. And one person, they started to panic, I think, because it was a weekend and they didn't get the coupon payment or the maturity, the redemption payment. It happened on the next working day. So if it does happen to, fall on a weekend, it can be delayed. But that's just the way it has to be a trading day. But it is just money that appears in your account, so it's pretty straightforward. Right. So let me just get rid of something that you can't see, but which I can, which is annoying. Okay, that's better. Lovely. Right, let's see if we've got any super chats. We haven't got any super chats. And we haven't got any supporters asking questions. YouTube supporters. What else have we got? Why is there a blow off top before a crash? Where does all the money come from? Yeah, I mean, often you see a very intense rally just before you see a big sell-off. certainly during periods of euphoria, and I think it's fair to describe what we've just seen over the last 2 years as a period of euphoria, as one narrative takes on the baton after another, with AI being the latest narrative to push up US valuations. So it's always a good idea to look at those valuations, and I think at the moment it's pretty scary. That's an overstatement, but let's have a quick look at valuations right now. And one of the ones which is quite useful is the excess cape yield. So let's pull that up. So as part of our membership, you get this dashboard. So I'll launch the trackers, and then you can kind of track this stuff. So let's have a look at stock valuations right now. And it is pretty shocking, depending on which measure you look at. So the forward price to earnings multiple, if we go to the 5-year average multiple, which is 19.2 times forward earnings, the forecast earnings over the next 12 months are $257 for the S&P. Multiply by 19.2 and you get 49.34 for the S&P. Now that's 16% below where we are right now. So based on valuations alone, you'd expect, an overvaluation of about 16% if we go back to the 5-year average forward PE. If we go to the 10-year average, it's a fall of 22%. If we go to the very long-term average, it's a fall of 34%. So a lot of euphoria is baked into the market right now. I think it's fair to say. According to Schiller Cape, we're at a multiple of about 43, which is very, very high. It's been cheaper 99.4% of the time. And if we look at excess Cape yield, which adjusts for real yield, when real yields are high, that tends to push valuations down a bit, fair value down a bit. So the Cape multiple, the fair Cape multiple comes down if interest rates are high, and if interest rates are low, it pushes up the multiple as people are buying more risky assets, because safe assets don't generate much yield in those situations. But if we adjust for real interest rates, again, when this number's low and red, it's when it's expensive, and we're currently not far off the 75th expense percentile. The median excess Cape yield is about 3.5%. Currently, we're at 0.7%. So very low yield, excess Cape yield on the S&P. And if we look at the US and see what proportion of the time it's been cheaper about 92% of the time if we look at Cape. Similarly for India, it's the only market which is more expensive than the US. It's been cheaper 93% of the time. So overall, I'd say this is a pretty scary market. And the question is it going to revalue downwards, re-rate downwards very rapidly? And that's the problem, right? Which is you can look at these valuations, but they tell you nothing about timing. And when valuations are very high, it does increase the probability of a fall slightly, but not by much. So I think you never know you're in a blow off, as you called it, until it happens. So that's why I think valuations are useful, but it really, I think, only informs you if you've got a big lump sum to invest, in which case you might want to drip feed. But if you're just saving normally, I'd say carry on, because markets can stay expensive for years. So I wouldn't panic too much about a huge fall. But look, it happens, so you just got to be ready for it. So I'd say now is not a bad time to de-risk when markets are still high, if you feel as if you've got too much risk. So imagine a 30% fall. Think how it would feel psychologically. Think how it would affect your finances if it happened. So that's your risk capacity. Risk appetite is about psychology and how much it would hurt you mentally if there was a 30% fall. And if either of those are kind of unpalatable for you, economic risk or emotional risk, then now's the time to de-risk a bit, because markets are still high. If that's what you feel, if you feel you've taken on too much risk because you've got caught up in the euphoria. So But why is there often a blow off top? Simply because of the narrative. The narrative takes over and becomes self-perpetuating. People throw caution to the wind. They use crazy phrases like valuation doesn't matter anymore, we're in a new era, this time is different. And this is what my video recently was about, which is this the biggest bubble ever? Some people said it was clickbait, but it really isn't. I think this is a huge bubble. And I think a lot of the narrative AI narrative is simply going to be difficult to satisfy, because if people are expecting Nvidia, for example, to generate increase in profit at the current rate, then it's just not sustainable for any company. There's going to be disappointment at some point, and it's probably not too far away for Nvidia. But look at Tesla, the results today, poor sales and expectation that sales won't improve much, as there are so many cheaper competitors nowadays that you just think, well, do I have to pay the premium ticket price for this when I've got something which is 20,000, 30,000 cheaper, which has a lot of the same features? The thing about electric cars is they're all really good when it comes to acceleration. We've got an MG, which is not a top model by any means, but you really feel it when you accelerate. And so performance cars are kind of standard now. For a family hatchback, you get incredible acceleration, what you would have expected from a sports car 20 years ago. And that's why I think it's difficult to compete in this industry, when a lot of it is about battery technology and software. So, that's the trouble with these disruptive companies like Tesla, like Nvidia, like the Magnificent Seven, which is that eventually they lose their ability to surprise you with really rapid earnings growth. So that's my worry, that the narrative somehow implodes. But look, we're going to get Trump in power end of this month. He's going to be sworn in. Actually, sooner than that, isn't it? January the 6th, I think, he's going to get sworn in. So we'll learn about his policies. We'll see the executive orders coming thick and fast. And we'll get a much better idea of where we're headed in terms of US policy, which is probably the most important thing over the course of this year. And then we'll have a better way of judging risk, I think. We've got a super chat, thank you, from ENP. Thank you for that. And they say, Happy New Year, and thanks for all you do. My pleasure. I really do enjoy it, actually. I was thinking about that today. I do enjoy it. Thoughts on Vanguard FTSE UK Equity Income Index and the methodology underlying the index. So let's have a look at it. So, UK equity income. So, of course, the party trick for the UK is income, as we know, because UK stocks tend to have high dividend yields compared to US stocks, for example. So you buy a US stock, it's all about growth, capital growth. You pay a little bit today, you get a lot in the future because the price goes up. In the UK, a lot more of the return comes from income. And it's a market which has grown up really based on high dividends. And that's been the way for many years. So companies which pay a high dividend are favoured on the UK market. And you could argue that's why the UK is so small, because instead of capital growth, which increases its market cap, they've focused on giving money back to investors. The price of that is that the capital gain hasn't been great. Also, the total return hasn't been great. Even if you include the income compared to the US, the UK has just not been very good at growing profits, which is unfortunate. Maybe it'll be different in future. But let's have a look at that index and let's see if I can find its definition on equity income index. And it's a FTSE Russell index. So let's see if we can find it. Yeah, here we go. Right, so with any index, you can always pull up the fact sheet. And this one's by FTSE Russell, obviously. They create the FTSE indices. So these are stocks which are characterised by higher than average dividends, which is pretty high for the UK, and is based on the FTSE 350 index, which is the the FTSE 100 plus the FTSE 250. So it's the large caps plus the mid caps. And it's obviously got a tilt towards the ones which pay a higher dividend. Now, another way to look at high dividend is high value. These are stocks where the income which it pays, which is in the numerator of dividend yield, is high relative to the price. So you could say that these are cheap in terms of the dividend they pay. The number of pounds you pay for every pound of profit, for every pound of dividend is high. Let me get it right. So the income is high relative to the price. So you don't have to pay a lot for a certain amount of income. The other way to think of it is to flip that fraction, and you've got earnings yield or dividend yield. So you've got dividend in the top, price on the bottom, and dividend yield is the way we usually describe income funds. So it's another way of thinking about cheapness. So these are cheap stocks. And if we look at the year-on-year performance, it's nothing like the US, which has been returning plus 20% over the last 2 years. In 2023, the total return on this index only was 6.7%, so not great. Yeah, that's quite depressing actually. Okay, and this is the. Do we have the valuation multiple? That would be interesting. No, these FTSE Russell's fact sheets are just not very good compared to the ones from MSCI. They're just less informative. But if we have a look at the holdings, you can kind of see the tilt. Which sectors pay a lot of dividend? Well, it's sectors like banks, for example, HSBC, Rio Tinto, miners, tobacco, oil and gas. So you can see the tilts. A lot of miners, a lot of financials, and things which tend to pay a high dividend. Often they're kind of defensive stocks as well, which pay a high dividend. But the dividend yield for this index is 4.8% versus 3.5% for the FTSE 350. So you are getting an extra percentage point of yield, 1.3% percentage points higher than the FTSE 350, the parent index. But that's how it's constructed. Usually with these indices, they also are fairly careful not to distort the sector composition too much. So I don't know if they apply that for this index. Certainly not very talkative about the methodology. So you see if it's... Oh, here we go. There's a capping of 4.75% per security. So no one stock can have a very high weight of above 4.75. And then the industry weights are 25%. So that's another cap which they impose. I don't see a sector composition of this. That would be good, but it doesn't have it. Okay. But that's the way it's constructed. You've got a parent index, you tilt towards stocks with that which have a high dividend yield, and that's how it's constructed. With these caps on sectors, no more than 25% for each sector, and the other cap is on individual stocks, no more than 4.75 for each stock in the index. But that's the kind of tilt you end up with. The trouble with income funds always is that it ends up with a weird sector tilt. Now the UK is weird anyway because it's got no tech, very little growth stocks, and if you tilt towards value and towards high dividend yield, you end up with these things. A lot of miners, a lot of banks, a lot of utilities usually, they tend to pay a high dividend. So you do end up indirectly having a sector tilt, which is also quite weird. But yeah, that's the price you pay. And often quite low total return, as we saw. So I think it's better to go for a high total return, which is high capital growth plus income, because that, I think, is more likely to generate good returns long term. The risk with going for a high dividend yield index is that because you're effectively starving these companies of capital, they're paying it to you rather than reinvesting it in their company, you're stopping them from growing. So what could happen is it could underperform in terms of capital growth. And that means that your income will fall in real terms long term. So you start off with an income which is sufficient in early retirement with one of these income funds, but gradually what happens as inflation erodes the value of your fund is in real terms your income falls. Whereas if you go for a combination of high capital gain plus income, a bit of income, then you can always sell a bit of the stock and that way get a better overall return. So I think this kind of fixation with income isn't necessarily healthy. You know, there are certain environments in which it kind of makes sense to buy, it makes sense to buy low, high income funds. For example, if it would generate a capital gain and it's held outside an ISA or a SIP, then yeah, you can always hold a dividend paying fund in a general investment account, because that way you don't have to realise the capital gain. You just hold the fund and it pays you cash, which you obviously have to pay tax on. But if you're not worried about capital gains, then I think just go for total return if it's in an ISA or a SIP. Thoughts on it? Yeah, I'd probably avoid it. Personally, I wouldn't buy it because the total return's likely to be lousy. The next person, I can't pronounce your name on YouTube. It's Ma Oe. The surname is Oe, if that's the surname. Ma Wei, maybe. And I think you're in Switzerland because you're paid in Swiss francs. But anyway, thank you for the super chat. And they say, I really like your scatter plots where you combine valuation and subsequent 10-year returns. Do you also... Let me see if I can find it. It cuts off there in the document. Do you also have this data for other country indices? No. And the problem here is getting the data, because getting historical valuation data is pretty tricky. The scatter plot I usually use is from it's based on data from Robert Schiller, because he's got 140 years of data going back to 1880 and 1870 maybe, and he's got historical time series for valuation, that excess cape yield, earnings, dividend, almost everything, and also inflation. So it's got a bit of macro thrown in too, plus the 10-year yield, I think. So it's really cool data set, and it's free. Just go to his Irrational Exuberance website and you can find the spreadsheet there. But that's why I've got data for that. There was a website that used to show these Cape scatter plots for multiple regions, but it's since become behind a paywall, so I don't have access to that anymore. But yeah, it's really a matter of getting the data, and I don't have access to the data, unfortunately. But it is, pretty interesting that, when valuations are high, you get lower returns. When valuations are low, you get higher returns. And intuitive as well, right? It kind of makes sense. But yeah, I haven't got recent valuation data. Let me see if I can find the old forward. I think I used to have the link. Let me see if I've still got it. If you just give me 1 second. Valuation. Nope, don't have it anymore. But I'm almost certain that the company that used to publish it, I think it was called Star Capital. It was one of our members, of course, which told me about this, that the site had disappeared. Star Capital. But I saw that Lynn Alden had it on her website. Cape by country. Star Capital, yeah, it used to be Star Capital. Yeah, let's have a look at Lynn Alden. She's still got the stuff on her website. Where is it? So I think she just borrowed these from their site. So these are the graphs we used to use. So here it is for all equity markets for Japan, Germany, USA. And you can see there's this inverse relationship. So on the x-axis, you've got cyclically adjusted CAPE, so the CAPE ratio, and then the y-axis is the subsequent 15 years of returns here. And you can see the inverse relationship. Expensive, lower return, cheap, higher return generally. The R-squared is far from perfect, so sometimes you get good returns when it's expensive, sometimes you get poor returns when it's cheap, but that's the general pattern. And it's pretty robust across different countries. So Sweden, Denmark, Japan. Yeah, so there we go. And yeah, excess CAPE yield is probably a better measure because it takes into account interest rates, I'd say. Back to your questions. What we do have, which I showed you on the website, is a measure which I often use in my video for the beginning of the year, which is where to invest in 2025, 24, 23, and so on, which is this graph. Let me just refresh that. Here we go, this one. So this looks at how often each country's been cheaper than the current CAPE measure, because each country has its own typical CAPE value. Some countries are often more expensive than others. So the US has often been expensive, the UK has often been cheap. So by comparing with its own CAPE history, you can work out what proportion of the time it's been cheaper. So the India's been cheaper 93% of the time, the US has been cheaper 92%, and so on. So I think that's a useful measure. So that's based on historical CAPE, but it doesn't do the 10-year following return because I haven't got the data. Sorry about that. For a nerd like me, you know, I'd love to have that data, but it is quite expensive to buy. Okay. Back to your questions. Remember, do subscribe to our channel if you enjoy this content and our other content. How are we doing for time? Half time. Let's see what we've got. A lot of people using the word predict. I don't generally predict because it's not worth it's not worth the breath. Okay. Oh, I like that. Rajaseelan Ganaswaran says he speculates a second Trump pump on the way to inauguration. Yeah, maybe. I'll tell you another video. In fact, I just shot this one. Someone's talking about Bitcoin. He says, don't laugh, but Bitcoin ETFs, Trump effect, etc. I'm not suggesting sticking it all in, but a small punt in the fund portfolio. Very few platforms seem to stock them though. So the video I just shot, literally minutes before I started this, is about MicroStrategy and how you can use that as a Bitcoin proxy in the UK. Because in the UK, of course, we don't have Bitcoin ETFs because our regulator, ridiculously, I think, doesn't allow that to exist. Even though a lot of the risk, I think, with cryptocurrency comes from the exchange. We've seen several exchanges go bust, been hacked, and so on. And, you know, even if you store it in your own cold wallet, there are still risks when you trade on a platform. Whereas if it was an ETF, it would have all the protections and all the efficiencies and cheap trading costs of trading on an exchange, a regulated exchange like the London Stock Exchange, while still giving you exposure to the crazy volatility which people like, and of course the very high returns which people love. So, you know, I think if we did have ETFs which give you exposure to Bitcoin or, if you know, Ether or whatever you choose, then that would be a lot safer for UK investors. But as it stands, we have to buy MicroStrategy shares which are a levered version of Bitcoin and even more risky, which is not what the regulator probably wanted in the first place. And the fact is, people are going to do this. You can't stop them, really. You can try, but then we could hold it inside an ETF, inside an ISA, we could hold it inside an ISA or a SIP and get all of the capital gains tax benefits and income benefits from that. But still, anyway, the next video which I shot today was all about that, MicroStrategy. And Roger Seelan also says, please tell me no teddies were harmed in the making of this episode. They weren't. Teddy was never harmed. He was a bit soggy, but he kind of likes it when I dry him off, so that was fine. Okay. WisdomTree efficient core ETFs are 90% stock, 10% cash, 60% bond futures. Basically a levered 60-40 tangency portfolio. I was wondering, do the bond futures have a baseline return? Well, bond futures are just a levered version of the bond itself. So long-term returns for bonds, if we look at the base rates, let's just pull that up. Yeah. Okay, so for the US, 1900 to 2022, bonds on average returned 4.7% per year. Subtract inflation to give real return, and you get 1.7. So you'll get a levered version of that, whatever the leverage is, maybe 30%, something like that. Not a lot more. Depends on the leverage of the fund itself. But it's funny because I was thinking about doing a little experiment with return stacking. I don't know if you've heard of that, but I follow this chap in the US, Corey Hofstein, who talks about his return stacking ETFs in America, which of course we can't buy in the UK. And it's not the National Tree Safety Group, I assume. Yeah, okay. WisdomTree Europe. And let's have a look at their ETF, because that sounds interesting. But yeah, I was interested in seeing if I could produce something similar in the UK myself, a kind of DIY return stacked ETF. And it is tricky because the critical ingredient is, yes, you can get levered S&P, yes, you can get levered bonds, if that's what you want. But what you can't get in the UK are what they call CFA funds. In the US, But the idea is that you've got these funds which can go long or short in the futures market. And if it's a trending upwards market, they go long. If it's a trending downwards market, they go short. And see if I can find Corey Hofstein's thing. He's got a really great note on return stacked funds, where he kind of lays it all out, how it works. He's really kind of transparent about the stuff he does. I think he's even got a GitHub repository where he talks about code, where he shares code to do return stacking. Yes. Let's see if I can find it. But it's that kind of managed futures fund which is not easily available in the UK, and it's a fairly critical component because the idea is that it's uncorrelated with the fixed income side of your portfolio or the equity side, because it can go long and short. But can I find it now? No. Okay, that's disappointing. But if you are interested in looking this stuff up and the research papers, let me just show you the website because it's really good. And Flirting with Models is this podcast, which is also very good, but a bit technical if you're not into finance in a deep way. But yeah, so he talks about how return stacking works, and there are some white papers on this website where he talks about the funds which he uses. But they're only US available ones, unfortunately. The managed futures fund is the kind of ingredient which is missing in the UK. The basic idea is very simple, which is that you've got so let's say you've got 100 to invest. What you buy is a levered version of the equity. So instead of having to pay, I don't know, 60 quid to buy the equity exposure, you get 3 times levered, so you only have to buy a third of that. So you only have to buy £30 worth. And then the extra cash which is left over, you've already got the equity exposure in levered form. The extra cash which is left over, you can invest in something which generates a steady, safe income, which is uncorrelated with the equity returns. And that way you get the diversification benefit, but you also get the equity return plus something. That's the idea, and that's why it's called stacking. But it does require leverage in order to generate it. But yeah, brilliant idea. Very old idea, it has to be said. And as time goes by, we'll see the return on those funds, which will be interesting. But NTSG, I guess, is something which is a similar idea. Let's have a look at this. There we go. WisdomTree of Global Efficient Core ETF tracks the price and yield performance before fees and expenses of the WisdomTree Global Efficient Core. 90% exposure to large cap global developed equities, 60% to global government bond futures. So notice, that doesn't add up to 100. But the idea is that some of the exposure is leveraged. So it's a low fee core equity solution that can complement other active and passive strategies. That sounds interesting. Maybe I could use that for some of the return stacking stuff. Interesting. I haven't come across that before. Oh, this guy's the quant, which they often quote on their website, Pierre Debreu. Leverage exposure to 60-40. So it's kind of like a risk parity approach by the sound of it, where you take something which is diversified and lever it up. Interesting. Yeah, so this is return stacking. Oh, interesting. Interesting. I'll have a look at that. And yeah, I'll definitely dig into that. But obviously in a live stream, I can't really look at the historic returns. I don't know how long it's been around. Let's see if we can find the historic returns of it, because that is kind of interesting. It's kind of exciting, like seeing a hippopotamus at the zoo for the first time ever. Okay, let's get the return. Okay, it's only been around for a month, so it's early days yet. But yeah, who knows whether that's going to perform well. But interesting idea. Thank you for sharing that. It's really interesting. The person who shared it is BoltVid39. It always worries me when I read out people's names on YouTube, because you always think, is that some kind of urban culture thing which is going to show me up as being an old guy who has no idea what's going on? Good chance. Brilliant. So back to your questions. I see we've got lots of super chats now. So next one is for me and Hugo, who says, I have a large amount in UK FTSE stocks. Too much. I'm sorry for your loss. How would you approach switching the whole amount to VHVG or similar, given the hot market? Well, I mean, reasons not to switch would be if it incurs a capital gain, which you have to pay tax on. If you're holding that money in outside an ISA or a SIP. If it's in an ISA or a SIP, that switching cost doesn't exist. If you have high trading costs, maybe, that would stop you from switching. But if you're switching from one kind of equity to another, and in particular you've got a lot of FTSE stocks, well, you're just switching one equity thing for another equity thing. So the volatility will be similar. Both will be risky assets. You're moving into something which is more diversified. So remember, what you're doing is reducing your risk, not increasing it. So I'd say, unless your switching cost is high due to taxes or trading costs, I'd do it quickly, personally. There's no reason not to. And really, it's whenever I discuss changes with people, those are the thoughts. You can't control the past. You can control the future. You can basically discount the past, ignore it, and always have a portfolio which reflects your beliefs about the future from today. Don't think about the history. The only thing that would make you think about history is that tax liability. If you've got big capital gains, which you then have to realise in order to change, that would stop you from switching. But otherwise, I'd say just, start every day as if it's the first day. Stick to a long-term allocation and don't change it around much at all. But once you've decided on it, stick to it, and stick to it for a long period of time. Be a nightmare for your broker, because the worst possible client is someone who just never trades, because there'll be no brokerage fees, and the inactivity will reduce their profits often. So, be a nightmare client and just don't trade. Just pretend you're dead. That's always a good strategy, because those people often perform very well. Trust funds, because they don't fiddle with the portfolio. Next question is from Philip C, who says, invest 5 million in the global stock market and withdraw 3% annually adjusted for inflation. That's A. Or B, invest 3 million in global stocks and 2 million in money markets, relying on the money market income for the first decade. Well, yes. I mean, if you have the whole lot in equity markets, which is A, and then take money out, obviously that'll be very volatile. And if there is a big drawdown, then you've got no dry powder to buy more equity at a lower price. You'll have to crystallize the loss, which means that, let's say you start off withdrawing at a 3% rate. Equities halve over a month because of some shock. Well, now you'll be depleting the pot if you just inflation adjust your taking out amount, your withdrawals. Then you'll be withdrawing at twice that rate, 6% per year. And while 3% might have been sustainable, 6% is not, because that'll probably exceed the returns on your portfolio. So I think it's important to have some dry powder in case there is that equity market crash, because then you can live off the safe stuff and not deplete the distressed equity assets. Give the equity time to recover, and then live off the safe stuff until that happens if you've got enough. If it hasn't, at least it'll give the equity some time to recover, and then you can start to sell the equity. And then after that, after the equity market's recovered, start to sell some of the now highly priced equity to rebuild your buffer, your safe buffer in money markets. That's generally the approach people take when they approach a retirement. About 5 years before, you build up a safe buffer. Could be single gilts, could be equity market, could be bond ladder, so individual gilts, which you hold to maturity. So that's your safe bucket, is the gilts / money market funds. The risky bit is your global equity component that generates a long-term return. How much do you put into this safe stuff? It depends on lots of things, but I'd say for me, what I'm planning is to have about 3 years of spending money. And that way, if equity markets do tank, I can live off the safe buffer for 3 years, give equity markets time to recover. Maybe it won't cover the entire recovery, but it'll cover most of it. And then once the safe money's exhausted, switch back to your equity and deplete that. Another thing which people do is use guardrails. So instead of continually hitting the pot, by 3% per year, withdrawing 3% per year, and then inflation adjusting year by year, you monitor what proportion of the pot you withdraw in each year. And if the withdrawal rate gets too high relative to the size of the pot, you spend less and you withdraw less. You always steer back to the initial withdrawal rate. So you always steer back to 3%. So in a good year, you raise the amount that you withdraw. In a bad year, you would reduce it. and you steer to keep within a certain margin of the initial withdrawal rate. So if you start off at 3, then if it goes to 3.5, you spend less. If you go to, I don't know, 2.8, you spend more to steer you back to that 3%. So those are called guardrails, and it's always worth trying that out. But the idea is that way you don't deplete your pot. You have dry years when, if equity markets tank, you withdraw less, but it ensures that your pot doesn't run out before you die. So that's the benefit of guardrails. Anyway, if you just Google Guyton Klinger, Guyton-Klinger, Guyton Klinger, you can learn about that. Next question. And I realise we haven't had Teddy yet, so we will summon the pooch up the stairs. And if I open the door, he'll appear. I had a client today. I had a one-to-one with a client. I do these coaching sessions. If you want to learn about that, by the way, go to PensionCraft.com/coaching, where it's like this, but it's just you and me. But he has a pet treat company or a pet food company, and he was going to send us some samples for Ted, which I thought was really nice. We don't usually get freebies, but that was really kind of him, I thought. Here you are, Ted. Some treats. Stinky buffalo treats. There we go. That's 1 and 2. Should make you work for it. Go on, you do the standing trick. Yeah, it's easy if you rest on my leg, mate. Go on, you get down on the floor. Go on, you get down. Come over here. Okay, stand. Good boy. Well done, Ted. Very good. Okay, back down for Biltong. Go down to Laura. She'll give you the Biltong. We're listening. She's going to get you in a minute. Yeah. Anyway, well done, Ted. Good performance. So the next question was there he goes. Alfred Peckford. Hi, Ramin. Thanks for your work and Happy New Year. Happy New Year, Alfred. Does it make more sense to invest in an equal weighted or non-equal weighted S&P 500 for my SIP? Well, people always focus on the S&P 500. I'd say if you have a global index, at least if the US underperforms, which it often does when it starts off so expensive as it is now, you won't have to worry about that because you will be diversified globally. And if another country comes to the fore, or at least the US underperforms relative to the rest of the world, which it does more than half the time, just under half the time since 1975. If you look at the annual returns, the US often underperforms, and often for extended periods. It was awful in the 70s, it was awful in the 2000s, and the rest of the world seriously outperformed during those decades. So if we are entering such a decade now, which is possible, then yeah, you'd be glad of the diversification. But here you're focusing just on the S&P 500. If you go for an equal weighted S&P 500, and I have done a video about this recently, by the way, then you are tilting in a very large way to the smaller companies in the S&P 500, such that if you get to the 500th equity, the relative weighting is 30 times higher than it would be for the market cap weighted index. And I think the break-even point where it switches from being a lower weight to a higher weight is at the 100th stock in the S&P 500. So a lot of those stocks in the tail of smaller market cap get very heavily weighted. So it is the small tilt, it's a massive tilt towards those smaller companies if you go for an equal weighted index. And it's kind of interesting, if you read Robin Wigglesworth's book about indexes and the creation of index funds, which is called Trillions, brilliant book, he talks about how the first fund that was index fund that was created was an equal weighted version of the S&P, but it just wasn't practical because they didn't have the computer power to do all the trading and reporting, And if you go for equal weighted, it's much more expensive to run, because market cap weighting, the beauty of it is that as prices move up and down, it just naturally adjusts. You don't have to do any buying and selling to keep in line with the index as a fund manager. Whereas equal weighting, you're continually churning. And particularly for the small caps where the bid offer spread is larger, that's very expensive. So that's why it wasn't really practical when markets first, index funds started to exist. So the market cap weighted of the version of the S&P did work, which is really interesting in terms of history of index funds. But the reason why you choose equal weighted, of course, would be that small caps would outperform. Also, value would outperform, because small cap at the moment in the US is value. Smaller cap, I should say. And the other tilt you'd be doing would be away from tech. So just bear that in mind. Just make sure that's what you want. So indirectly, you've got other tilts in your portfolio if you go for equal weighted. But if you're happy with that, if you think that value will finally outperform, that small caps will outperform large caps, yeah, it's a reasonable tilt. But just bear in mind, it does have those sectoral composition changes that go with it. You'll be tilting away from tech, which has worked so well for so long, and you'll be tilting away from the success stories of the S&P, which is a brave thing to do. But if you're contrarian, yeah, why not? Rajaseelan Ganaswaran has done a super chat, thank you. He says, thoughts on MicroStrategy and the QQQ nearing Euphoria? Well, in this video which I mentioned about MicroStrategy, I talk about that. I think what's kind of interesting is MicroStrategy really bet the farm on Bitcoin until it decided to buy it. I think it was in 2021. It was basically a washed up company, a washed up software company that just wasn't very successful or profitable. The minute it decided to essentially become a Bitcoin closed-ended trust, which is what it is now, its share price surged. So by almost any measurable quantity, it's been immensely successful, having that seemingly crazy strategy. There's also talk, it's now in the NASDAQ, but there's also talk about it going into the S&P. So they might change the rules to make it so that it can enter the S&P, which would also be quite surprising. But now it owns about 2.25% of all the Bitcoin in the world. Its share price is just very highly correlated with Bitcoin. In fact, it's done better than Bitcoin over 2024 by a factor of 2, I think. But for UK investors, it's a gift because you can hold it inside an ISA or a SIP. So that's why it's useful for us. But is it nearing Euphoria? Yeah. I think the fact that Bitcoin's done so well, Bitcoin is like a 3 times levered version of NASDAQ. It trades very closely relative to that. And I think that's another sign of euphoria. When Bitcoin does very well, it just shows there's a huge amount of risk appetite out there. So I'd say it's a pretty good euphoria measure, how well Bitcoin's done. And of course, at the moment, it's doing exceptionally well, although there has been a bit of a pullback. And for MicroStrategy, a huge pullback. Let's just have a quick look at the share price, because I was looking at that today. It is quite shocking how much it's fallen. So let's have a look at MicroStrategy, and I'll add the price of Bitcoin. So we went year to date would be kind of meaningless. Let's look at the period since the beginning of 2024. So you can see the correlation here. Bitcoin's in blue, MicroStrategy's in black, and it kind of tracks the wiggles up and down, but in a levered fashion. So you can see it's up by what? I think it was something like 350%, whereas Bitcoin was up about 170 from memory. So it's up by about twice as much. But if you look recently, in this kind of post-Christmas slump, the peak was around the 20th of November. But then really, it's the big sell-off happened after Christmas, which is around here. Christmas is here. And you can see that it's kind of tracked it down. Bitcoin's held up much better than MicroStrategy. It's sold off more. But of course it is a levered version of Bitcoin, so you kind of expect that. But yeah, it is a sign of euphoria, to answer your question, I think. Back to your questions. Andy Turley says, I want to hold 25% T26 Gilt, Jan 26th. That's when it matures. Idea is to buy stocks if and when there's a pullback. Interesting. How risky is it to sell before maturity if the pullback is June? Yeah. Normally what happens is if equity markets tank, gilts rally. So in theory, assuming it's not a spike in inflation which is causing the equity sell-off, how could that happen? Well, let's imagine gas prices surge tomorrow. Well, because we're competing with China for LNG exports, whatever. If that happens, we'll get another inflation shock. Now, inflation shocks are bad for equity, they're bad for bonds. In that situation, the gilt would not be a good hedge. It would probably sell off at the same time as equity. If you sold it in the secondary market, it wouldn't be good. Whereas a money market fund would have held up, because it hasn't got duration. It's got zero duration in a money market fund. So that's always the risk. With a gilt, if you sell before maturity, you're taking duration risk. If you wait until maturity, you're not really taking duration risk. Not really. It's more kind of FOMO risk, because if yields go up, you'll kind of regret not buying at a higher yield at a lower price. But just be aware of that. The benefit of buying a bond, a gilt, holding it to maturity is certainty. Certainty about the cash flows, near certainty about the yield you'll get, because you reinvest the coupons, so it's not perfect. But you know roughly what return you'll get is the yield to maturity. There is some reinvestment risk, because if you reinvest the coupons, you can't guarantee you'll get the same rate as you got for the bond initially. But usually you put it into a money market fund while you wait for the maturity date. But that's what you're giving up. If you sell before maturity, you give up that certainty. Now, if yields have tanked since you bought, the price will surge. Surge for bonds means what? 5%, 10% up. In which case you can sell at a massive profit. Massive for a bond isn't massive for equity, but you can sell at a profit and use it to buy equity. So as long as it's not an inflation surge, is what I'm saying, yeah, that would be a reasonable strategy. If it's just fear, or just people thinking, oh my goodness, how much have I paid for those equities? That was mad. This AI stuff is going to be really expensive, and it may not pay its own way, given the current infrastructure. Or, oh look, there are these competitors that can produce much less energy-hungry AI for a fraction of the cost. Whoops, we've overpaid for these really high-end chips, and companies which have invested in the wrong infrastructure, whoops. If that kind of rethinking happens all of a sudden, the turnaround can be brutal, because valuations are currently so high, everything's priced to perfection. I think in that kind of pullback, which is just a re-rating downwards, bonds will hold up pretty well. But like I say, if it's an energy shock, not so good. Not so good, because that's toxic for bonds as well. How are we doing for time? We're over an hour. So you get one freebie. Okay, so the Sub-077 says, thank you for your super chat, by the way. Thank you, Andy Turley, and thank you, the Sub-077. Is there merit in a risk versus reward approach? I'm 100% stocks, and I plan to get 70% into money markets based on a risk analysis comparing a 25% drop versus S&P 500 earning 2025 at 7k. Yeah, I think, always it's a risk versus reward approach. And I think what you're doing here is really sensible. You're kind of saying, well, let's do a mental scenario in which there's a fall of 25% for the S&P. How would I feel about it? What's my risk appetite? going to, is my risk appetite sufficient for that kind of fall? And if the answer is no, then yeah, de-risking into money market funds makes sense, because money markets are still giving you about, 4.7% in the UK and a similar amount in the US for very little risk. So now's not a bad time to switch when valuations are still high. So if you reevaluate your risk capacity, that's your economic ability to take a loss, or your risk appetite, which is your emotional capacity to weather a loss, and when you visualize that 25% fall, it either makes your quality of life worse if you're living off the money, or it makes your emotions just unbearable. You just feel terrible because you've made this loss. Then yeah, de-risk. Not completely, because that'll crush your future returns, but just to a level where you're comfortable with the risk. And that should always be true. You always need a portfolio that you're happy with living with long term. And that's not easy to gauge, particularly during a period of euphoria like now, because you'll just be thinking, I wish I'd put more into equity. And you'll probably chase this rally higher by investing as much as you can when things are expensive. And that's a problem. So if you have been kind of suckered into this rally and levered up too much or simply taking too much risk on, then yeah, now's a good time to reevaluate that, I'd say, when things are good, not when things are bad. Brilliant. So let's leave it there. Don't forget, we've got a free newsletter that's published every Friday. To learn more about that, go to pensioncraft.com/newsletter, and to do the coaching one-to-one, pensioncraft.com/coaching. So we can do this, but it'll just be you and me. Or if you want to join our membership, where you get access to all sorts of goodies, members only videos, there's a chat application, so you can share information, you can talk about anything you like, and I answer the questions on there too. If you want to join our membership, just go to our website. It's a premium website membership, pensioncraft.com/membership, and you can learn more about that. And of course, we provide all this free content, of course, so that you get to know us. But do join us, and we'd love to have you as a member and to chat with you. Join our membership, share your knowledge, and you'll learn a lot from us as well, I suspect. I'm still learning a lot, that's for sure. Anyway, thank you all for joining us, and do like and subscribe if you haven't already, and we'll speak again at the next one. Take care, everyone.